Joining us right now is Keith Banks. He is the head of CIO and Investment Solutions Group at Merrill Lynch and U.S. Trust as well, the president of U.S. Trust as well. Good to see you, Keith.
Always good to be here.
Thank you so much. And I know that you're seeing, well, $235 billion in assets under management. How have you allocated that capital under a Trump presidency?
Well, we're still overweight equities. We think equities have a ways to go. We like the underlying fundamentals, both in terms of economic growth here in the U.S. as well as globally. We are overweight emerging markets, overweight large cap U.S., and we also like small cap. We think the small cap stocks will be a big beneficiary of accelerating growth in the U.S. as well as hopefully some deregulation and tax reform that may come. And as part of that, we're also underweight fixed income.
A lot of people are talking about financial stocks just given they've had a huge run, but they still look historically cheap compared to some of their multiples of the past now, and they can continue further. Where do you guys stand on the financial stocks? It's
one of the sectors we like. A couple of reasons. Number one, as economic growth accelerates, that's good for banks generally. It's good for capital markets businesses. It's good for credit cards, good for loans. And there's a lot of leverage depending on the financial institution to higher rates. An upward sloping yield curve and a parallel shift in that yield curve is very powerful for bank earnings. So we still think there's a ways to go.
Is there any one particular group you find just hideously expensive that you are wildly underweight? I'm talking in stocks.
Hideously expensive. Well, we are. I love that. That's a great word. What we're saying is we would avoid, because with rates starting to move up, and we think that will be continuous. If you are looking at utilities or telecom, that in the past were basically bond proxies, any sector, any stock that's a bond proxy, they're going to start to get hammered as rates go up, because all of a sudden it takes away the allure of that bond proxy play.
But, well, let me ask you about earnings, because that's really what this market is rallying on, right? So if you were to see, let's call it a 20% corporate tax rate now, because Donald Trump has been saying 15%, but it's probably going to be 20%, right? Is that the way you see it?
That's probably a good guess.
What does that mean for corporate earnings? I mean, what kind of an earnings bump are you expecting in 2017? Because some people are talking about 20 to 25% higher.
Well, I'd start with, first of all, people are so focused on the tax reform, and they should be, but they forget the fact that the tax reform, we think this year you will see double-digit growth in earnings in the U.S. just based upon the organic things going on in the economy. With the U.S. economy ticking up, global economy, rates moving up, which helps financials, higher oil prices. So we think you're going to see double digits without any help from tax reform. The work that
double-digit earnings growth without the help from
tax reform this year. So and look, most of the tax reform, if it comes, quite frankly, will be a 2018 phenomenon, not necessarily a 2017. But Bank of America, Merrill Lynch has done a lot of work on this, and they're forecasting it could be another $5 a share on an earnings base of, call it $129, $130. So it's meaningful. It's significant.
Meaning the earnings recession is over. I mean, we've had terrible, 5 quarters at least of anemic growth, and so looking at the analysts, they expect 5.1% first quarter earnings to be up compared to last year. So that's interesting, and that's during Trump's administration. So it's the quarter coming up.
Yeah, look, the earnings recession is over, and if we start to see an uptick in nominal GDP, and we think this year in the U.S. you could see 4 to 4.5 and more globally, you can start to see finally some top-line growth, which has been the missing link during this entire rally. We've been able to see earnings growth mainly through share buybacks and significant cost reduction. That will continue. Corporate America, I think, will stay vigilant on costs. But if you start to see an uptick in revenue, you really see a lot of operating leverage show through, which turbocharges the bottom line.
Who do you think gets credit for the rally? Some people are saying it was President Obama who put everything in place, and other people are saying it's that President Trump was elected.
Well, I think it's both, right? I mean, I think there was an underlying dynamic during the Obama tenure that helped, but I think what people are looking for now is, can we break above that 2 or sub 2% real GDP growth in the U.S., because that's been the challenge. We've had great job creation. We've had what's going to be interesting actually next month is we will officially it'll be 8 years since we bottomed, the market bottomed in March of '09. And the second thing is we're going to be, next month represents the 93rd month of the current economic expansion, which means we eclipse the Reagan era. The 80s was 92 months, but the all-time record was 10 years, which was the 90s. So we've had a good run here, but it's been arguably with GDP growth being below what was typically the trend line. So I think the hope is if we get regulatory reform, tax reform, and get some infrastructure spending, you know, that sub 2% can tick up to 2.5 and maybe even be
because it was only fueled by monetary policy, not fiscal policy. So that's why this has room to run, because you had monetary policy push it this long, and now fiscal policy is going to come and lend credit.
You can't underestimate the policy coming out of this administration and its impact on earnings. I mean,
and look, and the hope is the focus stays there, because you're right. The 1-2 punch was monetary and fiscal. We've only had the jab with the monetary. If we get the fiscal coming in, that's when you can start to see some interesting nominal growth. That'll probably help inflation come back a little bit, but we don't think in a problematic way, all of which is good for growth in terms of revenues and earnings.
Here's a headline for you, Keith. Kraft Heinz this morning confirming it proposed a merger deal with Unilever. Unilever actually rejected the deal. Kraft this morning is saying that it looks forward to reaching a deal, so they're in a back and forth here. M&A, how does that play into things?
Well, look, if CEOs' optimism goes higher, and we certainly have had a spike in both corporate America and the consumer, I think you'll see more capital spending, I think you'll see more hiring, and I think you'll see more M&A. All three are good for the markets.
All right, we will leave it there. Keith, great to get your insight.
Always good to be here.
Thank you so much. Keith Banks joining us there. U.S.